Hi guys, let me ask you this. If you are relatively young and all you've seen is living at home and living in dormitories and student housing during your college time, and you are entrepreneurial and you want to kind of do something with what you learned, how do you go about it? Well, our guest today, Joe Kerley, is the perfect guest for that because he had exactly that situation and he decided, well, maybe I can find a way to make student housing in my community more affordable, more enjoyable, better managed, all around better. And he went after that and he made it. And now, even though he's only been doing it for less than a year, he already has 50 doors for students to rent. So come to the show and listen with me on how Joe, as a young guy with very limited experience, was able to pull this off and growing a real estate investing business with student housing. Hello and welcome to another episode in the Ideal Investor Show. Today we're going to talk a little bit of an adjacent topic to our normal single family and residential housing, and we have an awesome guest. Joe Kerley is with us today. Hey Joe, how are you doing today?
Doing great, Axel. Thanks for having me on.
Yeah, that's awesome. And we're really happy to have you because I think there aren't that many people who have the special expertise that you bring to the table. So before we dive into that, tell us a little bit, where you are right now and how did you get to where you are?
Yeah, absolutely. So right now where I am is I run a company called Sotol Capital. I started it maybe 8, 9 months ago. And right now we have, I believe, 33 units closing in on 50 to 60 plus bedrooms, and really excited about the trajectory that we're on right now. Mainly focused on student housing. And so, yeah, really excited about that. Now, how I got there, I've always been an entrepreneurial guy. Middle school, high school, always had these various businesses, entrepreneurial efforts, and ultimately graduated from college, university, and went off to Denver, Colorado to work for a private real estate firm that specializes in value add multifamily investing. And there I just got a great experience, a wealth of knowledge, but I've always been an entrepreneur. And so when I got that knowledge and some of that experience, I, found a deal and ventured off on my own and ultimately left that job and that opportunity to pursue starting this venture.
Okay, yeah, that's really awesome. And I mean, if you said that you added like under that name for less than a year, can you talk a little bit about when you say, okay, we have X number of bedrooms, how did you get your hands on, I don't know, is it one building or one facility or one complex, or can you tell us a little bit about that?
Yeah, sure. So right now we have two properties. How did we get our hands on this? Well, it was mostly through a syndication model
Hmm.
where we go find a good deal. We're really excited about the deal. We put it under contract and we raise capital from our investment partners.
Yeah, are you a GP then in the syndication or?
Yeah, so I'm the head sponsor and the lead sponsor on these. Now, yeah, I do have a key principal who assists with getting debt for
Mhm.
these projects.
Right.
But yes. Sotol Capital serves as the lead sponsor on these deals.
Okay, yeah, and just to remind our audience the fundamentals, because not everybody is maybe necessarily that familiar with syndication. So you have basically a general partner or a team of people who represent the general partner who do, I always say,
Right.
those are the guys and girls that do all the work, right? They find the project, they manage the project, they talk to the contractors, they probably do the marketing, all the things that are necessary to, and if it needs renovation, then manage the renovate, all that kind of stuff. And then there are what's called limited partners, which is basically private individuals who want to do a real estate investment but be really passive, have basically nothing else to do than just contribute the money. And there are different versions, some where you have to be an accredited investor, some where you can have some accredited and some non-accredited. But in the end of the day, the general partner can say, okay, one unit of participation is, let's say, $25,000. If I want to really be passive, I give Joe $25,000 and he tells me in 3 years it's going to be double. And I don't really have to do much else other than every 3 months get a report or an email or something like that. And then there's the lender who is basically typically in contact with the general partners to organize and provide the funding. If you, for example, want to purchase a property, then renovate it and bring it up to market rent, market level, or in your case, I'm assuming you want to keep it and rent it to students, and then basically have not just a buy, update, sell, but more like a buy, update, and operate kind of model. Would that be fair?
Yeah, that's very fair. I think a lot of operators and general partners in the space who maybe don't actively involve in student housing, maybe the past 3 years they've been more geared to buy, update, and exit just based on the market that we've seen.
Right.
But with student housing and kind of what we're pursuing is exactly like you said, which is a buy, update, improve, and operate for excess of 5 years plus. We're really excited about some of the properties that we have here, and we might hold for even longer. So, yeah, I would absolutely agree with that.
That's very cool. Now, I'm assuming when you rent, well, maybe let's start first too. Can you give a little bit of a description of how a property like that actually looks like? I mean, I believe most people in the audience can remember how a dorm looks like, but maybe
Sure.
that's a little different from how your properties look like.
Yeah, so I think some people will get often a bit confused about what we mean by student housing. So there are absolutely dorms where on campus freshmen or sophomores or maybe everybody will live on an on campus university owned dormitory that provides housing. And those will typically look like beds or bedrooms, very small bedrooms, and shared common halls, common potentially bathrooms, things like that. That's not the case with what we're doing. So we target typically mom and pop multifamily apartment buildings, standard apartment buildings that have a living room and a kitchen and a bedroom and a private, bathroom, all of the essentials that we know well. But what we like to look for is those same properties incredibly well located next to some amazing universities. And
Okay.
maybe they're leasing them out to students already, or maybe they're not. But we'll go in there, acquire these assets. Sometimes they'll be a bit rougher around the edges, maybe delayed improvements, haven't been touched in 20, 30 years sometimes. And we'll
Right.
go in there and improve them and make them modern and hip and more attractive to students and ultimately rent those out with the target tenant being a student.
And so would your ideal property be like 50 units, all single bedroom studios, or maybe one bedroom apartments or stuff? Or can you also handle something that is designed to be a little bigger? Because I don't know how it's in the Denver area, but most places I went to school, or I remember my daughter, anytime it had more than like maybe two bedrooms, you had to share just to burden the cost.
Yep. So, I typically like to look for a good blend of a couple of unit mixes. So I like to look for a good blend of one beds. I really like 2 and 3 beds. Once you get to 4 beds, it can get a bit interesting because I mean we know how college kids can get when maybe 4 people are living together or 5 people are living together, 6 people are living together. And so, sometimes that's good, but typically we try to stay in the range of maybe 1 to 3 beds. And yeah, that's what we look for. But absolutely, once you get to the 3 bed level, you're going to have multiple people, multiple students potentially on the same lease living together with their friends that they've made, maybe from a previous university year that they just had. Maybe they're sophomores and they're wanting to live with some new friends from university.
Right, understood. Now you said, people have a rough understanding of how sometimes college kids can be. Most apartment complexes that I've seen also have like common areas and stuff like that. Is there any kind of significant risk that this turns into like weekend party town or stuff like that? If all these students are in like one of those complexes, you said something, I think like 30 units in one or something like that, or 50 beds in one. I'm imagining 50 college students on a Friday night. That could be interesting.
It absolutely can be interesting. So the assets that we look at typically don't have really any shared study spaces or common areas or things like that or gyms. Not that anybody would be
Yeah, I
partying in a
thought more
gym,
like a
but
barbecue area or a pool or something like that.
sure. Yeah, we fortunately don't have pools. I totally understand if we extend maybe this conversation to just damage in general.
Okay,
Um,
yeah, yeah.
I think it's a very reasonable fear to have that young college kids could tear some things up. I absolutely agree with that. I have been a college kid not too long ago, and maybe at times was guilty of that myself. So the one thing that I love about what we target is we target the top 150 universities in terms of parental income. And so when parents make more money, we typically can ask for maybe higher security deposits. So in the event
Right.
of actual damage, we would have a nice bucket of security deposits to draw from that we feel really strongly about recouping any damage that would occur. That being said, I also will note that when students are living by themselves, or maybe they're just living with one other buddy, the risk of damage is tremendously lower than if they were living in a frat house or they're living with 10 other students or 5 other students. And so that's why I say we sometimes will try to veer away from a high concentration of of the property being 4 beds, 5 beds, things of those natures. And we'll try to typically steer to 1 through 3 beds. But yeah, those are kind of our thoughts on the whole damage situation.
Okay, yeah. One thing I was curious about, because a friend of mine in Ohio is doing something similar, but not on the scale,
Sure.
like more finding a 5, 6 bedroom house and then rent out those 5 or 6 bedrooms to students. And I'm curious what you would say about that, or if that is something that you consider. He makes it a point that the students that are going in are enrolled in graduate programs rather than, I don't know, undergraduates probably don't really get to live off campus, but like sophomores in an undergraduate program or bachelor's program, I should say, versus
Sure.
graduate students. Do you have kind of a view or how you handle that, or what your experience is on that?
I think that's a great question. I'll first note that undergraduate students often, and we probably won't look at university areas that will not allow undergraduate students to live off campus. The
Mhm.
whole point of the business model here is to capture those students that want to live off of campus.
Yeah, I mean more like freshmen, right? Like when they just enrolled. And I know
Yeah,
here
sure.
in California, where I live and where my daughter went to university, they said either you live at home, or if you're a freshman, you live in the dorms. We don't want freshmen. Yeah, yeah.
Yeah, that is very common for freshmen to live on campus and be mandated to live on campus. So I think there is a slight preference to graduate students. If you're 23 to 25, you might actually have a part time job as well.
Right.
You're going to be a bit more mature. Your brain is probably quite a bit more developed at this point. So, yes, there will be some preference given to graduate students. That being said, if we do have a parentally secured lease, we'll look past a lot of age related items. If we have a strong security deposit in place, I think all of these things really beef up the lease and allow us to be a lot more flexible on who ultimately is our tenant.
Yeah, that's very cool. And that's actually a good segue, because I've been wondering about this. When you look at a unit, you said, you like, for example, 3 bedroom units, right? Like, so you have a 3 bedroom unit. I would assume that this is, let's say, 2 or 3 women that decide they want to live
Sure.
together in this kind of apartment. How do you handle this from a lease perspective? Is there one lease and everybody commits to somehow contribute, or do you break the lease per bedroom and every bedroom is leased separately? And also, I'm always very curious, and I'm sure the audience is as well. What actually happens if somebody drops out or starts hating it or can't get along any longer? Those kind of things. Can you say a little bit about how that works?
Yeah. So I believe our preference is to actually just make it one lease. Just
Okay.
keep it super simple. And you almost want to delegate a lot of the responsibility of ironing out the logistics or any drama that occurs with roommates. You want to leave it to those people to figure out. So if you have one lease, for example, we will typically ask for multiple guarantors on these leases. Often it'll be strengthened by 1, 2, potentially 3 sets of parents who make a combined income of $250,000 each. That's an incredibly strong lease. Now, in the event of one roommate maybe not being pleased with the situation, we won't really intervene unless they truly cannot figure something out. And if it has to come to a revision of the lease, or sourcing an additional roommate to maybe fill in a third spot that has recently become available, we'll work with tenants on that. But mostly from our perspective as the operators, we really want the property management to take care of that. as an operator or general partner, I don't want to be incredibly involved with the day-to-day dramas of college kids and their social groups.
Yeah, I meant it more from one time in one of the properties that we were
Mhm.
basically having available, because the tenants, it was a regular family, moved out, and then a group of students came and said, okay, we would be interested to lease it. And the thing that ultimately led to not working was that there wasn't really a good answer to what happens for whatever reason, whether they don't like each other or grades aren't there or what have you. And someone, even just one, it was I think four or five that wanted to lease our house together, one drops out. So now the revenue is no longer there. They all, now I have to admit, they were all having out of school or after school jobs. Yes, the parents secured it basically to say, if they don't pay, then we are here as guarantors. But the plan or the fundamental understanding was the kids would basically have jobs and they would all contribute and then pay the rent together. But the issue was, what happens if one drops out, loses their job, drops out of
Yeah,
school, doesn't want to live with them anymore? There wasn't really a solution to, okay, well, how do we make sure that the revenue is still coming in, right? And yes, legally you can probably go to the guarantor, but that doesn't necessarily mean you have the rent on time every month. So
sure. Yeah, so I totally agree with that and understand that. I certainly take the opinion that you've signed a lease. This is a lease. This is a commitment to pay X dollars, every month. If for whatever drama or whatever situations going on within this household that prevents you from, in no way should come to prevent you from actually paying the lease. You're still on the hook for this amount of money. If, this is one of the reasons we shy away from 5 people, 6 people living together, because it increases your amount or your odds of maybe issues occurring.
right.
But yeah, if one of them flakes out and skips town and moves back home with their parents, the bulk of the people in there are responsible for, backfilling and filling this lease. And so that's how we view it.
Yeah,
Yeah.
some of it I think are probably property management questions that I have. It's just I remember
Yeah. Yeah.
when I said to our little crew that wanted to rent a house, I said, so how about we just do the lease agreement with one of the parents? You guys give them the money and they just pay me. And they're not going to be flaking out or running away. They know that they sign an open, just exactly what you just said.
Sure.
I remember the scene literally as if it were like just 10 minutes ago, where they, oh, Ukraine, no, and we know no way are we going to have our parents involved. They were okay with having them as guarantors, but moving
Right.
money around, no way.
Yeah.
So,
No,
now,
that makes
I
a
mean,
lot of
one thing
sense.
is, since this is the Ideal Investor Show, from the investment perspective, right? Can you talk a little bit? I think everybody gets an idea that it's not just, okay, I have a facility and I put people in and it's flip a switch and then it makes money like crazy, right? There's things to
Sure.
consider. And I think you described it perfectly and nicely on what are the considerations and how are you coping with this. But when we switch a little bit to the looking at this as an investment opportunity. If somebody were to say, Axel said this syndication thing with Joe is really a very passive thing for me. I can see myself parking 1 unit's worth, whatever your unit size is, of money with Joe and let him run this syndicate. Well, I don't know if you probably do the syndications per property or a little group of properties.
We do, yes.
So can you talk a little bit about what is the promised or maybe to be expected outcome of an investment?
Sure. Great question. So, yeah, what's the expected? It's deal by deal, but what I'll say is we typically won't pursue a deal if there isn't some meaningful cash on cash return. So that looks like typically in excess of 6 to maybe 11%. 11 is going to be obviously at the very high end, but it's going to be 6 to 11% in those cash on cash. All of this, just for, liability purposes, all of this is projected.
Right,
So
obviously, yeah.
it's our job to realize this, but this is what the projected profile of these investments look like. So it'll be 6 to 11%, maybe cash on cash returns. The IRR, which in layman's terms, we could just, for these purposes, call it annual returns once we exit the property. That's not exactly what it is, but for layman's purposes, we can refer to it as such. We look at returns 15 to 20, sometimes excess of 20% on an annualized basis once we exit. And so that's kind of what the profile looks like. From the investor perspective, you look at a deal that we send you. We say, hey, here's why we love it. It's got a great location. We have a very concrete plan. We can fetch these rents with a high percentage of confidence that we can fetch these rents. You then, wire funds in, make a commitment. But from then, it's extremely passive.
Right.
We communicate, 4 times a year. We send you tax return informations at the end of the year. But other than that, it's incredibly passive. You don't have to worry about the drama or the roommate issues, or maybe somebody, kicked a little hole into the wall. You don't have to worry about that. That's kind of the job of property management and the general partners, so that's kind of what the profiles look like.
Yeah, understood. And I mean, since you said you're relatively new to it, is it fair to assume that you haven't had an exit event yet?
No, yeah, no exit. Probably will not exit, especially kind of with the market conditions going on right now. And values, depending on what you look at, are still climbing, but I think the waters are certainly getting muddier. We probably won't exit for 3 to 5 years on these deals, potentially more, because
Right.
we're excited about the rents that we're fetching, and our cash on cash returns right now are looking to be much more promising than even, we forecasted. So we're really excited about just getting them running and keeping them.
Right, understood. Now, one thing that we didn't mention in the design of the deals, I described it briefly when it comes to how syndications typically work. But is it
Sure.
fair that for the acquisition that you use leverage, that you get funding, other than the
Yes.
money that the investors put in? I mean.
Yes. So we do use debt.
Yeah,
Correct.
okay. So that's actually, I just wanted to confirm that because we talked about how is the overall market environment changing. So to secure funding, I'm sure it's the same for you, like for me, like for anybody who wants to do investments, even real estate investments, which I would still say are the best type. If you look at the environment that
Oh,
we've seen,
absolutely.
bonds is crap, stocks is crap, crypto is crap, right? I mean, if you say what would be sort of like the big categories, I actually, honestly, even though I have a reserve in precious metals. But if you
Mhm.
would have told me a year ago that we would see the development on inflation, war in Europe, the stock market situation, the Fed situation, and
Mhm.
gold and silver have barely moved with
Yeah.
all of that going on. So that is kind of crap too. You can put that
Yeah.
on the crap pile. So in that light, I think even though we hear a little bit of little blurbs of stuff from so-called experts, I would still say far and away real estate is the best area, the best part of any kind of investment market to be in. And we have the proof now compared to everything else. But at the other hand, we can't really deny the fact that the Fed has increased rates and the
Mhm.
markets for funding have taken this, I believe, to extreme levels, right? Like the Fed increased the rates by 0.75%, but mortgage rates are 2% higher, or funding
Right.
rates are typically 2%. So, like close to 3 times as much as the Fed has moved already. Does that mean that they're going to stay ahead that much going forward? Maybe not, but it's still gotten more expensive. So I guess in a long-winded way, my question is, how do these market changes, especially in the cost of doing business, cost of securing funding, impact that model where you said 6 to 11% cash on cash
Sure.
and maybe overall 20% if you look the average of the life of a deal? How much impact is that going to have on your deals?
Yeah, great question. And I think economists and people will be talking about this for a really long time. For our deals, we really like fixed debt. So we try to exclusively do fixed debt. For example, and this is only, like I said, 8 months ago, we had 3.25 fixed debt on our first property.
Right.
And so we're really excited about fixed debt because, yeah, when rates go up and inflation's kind of on a tear, inflation can also affect our rental rates as well. And so,
Hopefully they will.
yeah, we certainly hope so. And so we've seen that. We've seen rents go on a tear. And yes, costs have come up. But when you have fixed debt on that, I think it only improves from a theoretical perspective, only improves your cash on cash returns. I mean, you can think about it pretty intrinsically.
Yeah, right. But I'm just wondering, if you were to have to go out tomorrow,
Yep.
right,
Yeah.
and say, okay, well, I have another deal, same property next door, down the street,
Yep.
whatever, same university. You gave me 3.25 8 months ago. They're going to ask you what, five and a half, six, something
Yeah.
like that.
They'll ask 5 to 5.5
Yeah.
today.
So that's
I
not
absolutely.
quite double, but it's pretty
Oh, it's,
substantially
yeah.
more, right? So is that like a 25% impact on the returns that an investor can expect, or how big of an impact does that have overall?
Yeah. So what I would say is our investment criteria in terms of what we look for in returns, we don't want to change. And so what this means is when rates go up, it makes it more expensive to buy properties. And so, properties, ultimately, in theory, the properties we look at, we can't be as aggressive on price as maybe we in the past were able to. And so, we won't do the deal unless it makes sense at the rates that we're seeing in the market.
So basically, you got to find a juicier property, so to speak.
You got to find a better deal. It kind of squeezes our investment criteria. It makes it a bit more difficult for us to go and source deals. But on our end, we're really excited about some of the off market deals that were being sent. I mean, there's a lot of meat on the bones with certain investment opportunities that have been sent our way. But yes, it absolutely does squeeze our ability to go and buy because you're just constrained by the cost of that debt.
Yeah, and for our audience, my perspective on this is when people say, why would that be what you just said about the opportunity, right? If you think
Sure.
about it, if somebody invested in whatever way they ended up getting their hands on it, let's say right after the big financial crash in 2010 or 2011,
Hmm.
they got their hands on an apartment complex because maybe it was in foreclosure or something like that.
Right.
Right? And just for sake of argument, they paid 500,000, right? And here we are 12 years later. That thing is probably worth at least 2 million. And they may not have even done much in the last 12 years, right?
No, yeah.
So if you can make the numbers work from the cash side, that 2 million in comparison to what other places would be probably 3 million. So for you, obviously, it would be a good deal. For them, it's a good deal too, because they quadrupled their money in those 12 years, which is a really good return, and they got all the tax benefits and blah, blah, blah. So
Right.
both sides make a good deal. I think what is a little bit forgotten in the bigger picture, which is always what I pride myself in our mentoring, is
Yeah.
you want to step back, look at the big picture and say, who would be motivated to make an offer off market or on market to Joe? Are the people who held properties for a while and have now all that equity in these properties because of the substantial increase in valuations in the marketplace. And if you bought something when you were 45 and now you're 57, you say, okay, I'm about ready to retire. It would be nice if I could realize $2 million,
Right.
right? Or 59, so they don't have to pay any kind of, whatever something like that. Or I feel ready to retire and I want to realize the equity out of this deal. Everybody in the deal like that. So I think that's underestimated. How many deals are there that have been kind of cooking and sitting and working themselves and operating for 10, 15, 20 years, where people say, well, the market is probably not going to continue on this trajectory. It's probably going to plateau for a while before it can
Sure.
rise again, especially with the high interest rates. So if there's some operator who wants it and gives me all that gain, I think I don't know if I'm only seeing this in our market. I'm not obviously a
Yeah.
multifamily student rental operator. Would you say that side is a little bit forgotten oftentimes?
I agree. I think a lot of the deals that are starting to come across my desk are that scenario that you just outlined. I think a lot of operators are coming to the age where they've owned these assets and maybe it's a mom and pop operation, maybe it's slightly a bit more institutional. Most of the time at the size that we're dealing with right now, it's mom and pop and they bought it when they were 45
Yeah.
and they like you said they're 59, they're 60 years old now and cash is tremendously more valuable to them than a property at this point. It could be because they want to go on vacation and they have, maybe they're 70, maybe they're 80 and they actually want to live their life. And so cash might really be valuable to them at this stage in their life.
No, I totally agree. I think part of the other thing is we all really have to work hard. I work hard on it every day to not getting too much influence from the media, which is
Hmm.
basically saying everything is crashing. You should have cash so you can buy the dip. Right? Well, but first
Yeah.
you have to have cash, right? And I'm not really subscribing to that view because I wouldn't recommend for a 60-year-old to say, okay, when the market is finally at the bottom, I mean the stock market at 60, I'm using my 2 million cash that Joe gave me and buy stocks. Not something
Hmm.
I would recommend. But when you constantly hear everything is crashing, well, then you obviously, if you have especially been an investor in something like this, like you and I and people like that would be investing in, you would say, well, if I had cash and I can catch it at the right time, like I did 15 years ago, I can maybe do
Sure.
another deal like this, right? So it's not just to use the cash for consume or to consume it through travel and stuff. It might also be just the influence from outside to say, hey, you owned it, you made a good profit, you might want to realize the profit.
Yeah, I
Cool.
agree.
All right, so now that we're coming a little bit to the end, we always ask 2 questions to every guest. So I have to ask you as well, Joe. If you could meet anybody, past or present, that you would love to meet, who would that be and why?
Yeah, it's a great question. There's a couple people I would love to meet. Tiger Woods, just an incredible man, incredible athlete, transformed the golf game that I certainly love. And then also probably Teddy Roosevelt, very interesting, one of our more interesting presidents. He used to have boxing matches in the White House. He lost an eye while he was a president because he was in a boxing match. He was sparring, and he's just an incredibly interesting outdoorsman. And yeah, those would probably be the 2 people I'd love to meet.
Okay, yeah, that would be really cool. When you meet Tiger, you have to tell me what came out of your conversation.
Yeah, yeah, that's my life goal.
Yeah, all right, cool. And then the other question that we always ask everybody, if you had a time machine, you could go forward, backward, however far you wanted to, where would you go and why?
Yeah, I mean, I'm so curious how the pyramids got built. Would love to just sit for maybe a couple hours and watch them somehow construct that. And then I think, again, going back to golf, I love golf. Probably watching certain Masters performances. One of the biggest majors of the years is the Masters tournament in Augusta, Georgia. And watching somebody like Bubba Watson wrap it around a tree to win the tournament. Or, there's certain shots in Masters history that I would just love to be there for.
Awesome. Okay. Yeah, that's very good. And that's probably a really interesting journey to go on. Well, thanks for sharing that. And Joe, thank you again for being on the show. Now, at the end, if somebody got intrigued to say, hey, being really passive, working with Joe, he does the student rental stuff. How can people get in touch with you to learn more?
Yeah, so firstly, I would say come visit our website at sotolcapital.com, SOTOL capital.com, or reach out directly to me. Joe at sotolcapital.com is my email address. So yeah, that would connect with me on LinkedIn, what have you. I think there's plenty of me out there, so that should get you on the right path.
Okay, yeah, thank you for sharing that. And obviously the links and stuff we will put in the show notes. So anybody who is either watching this on YouTube or listening to it on Apple or Spotify or any of those platforms, you will find that in the show notes if you want to follow up. And you can always also contact me and then I make the connection to Joe. So again, Joe, thank you so much for coming, explaining a little bit about this kind of unique corner of the real estate investing market. And we wish you all the success. And I hope you're going to have a really, really successful first exit event when it comes to it.
Well, I do too. Thank you, Axel, for having me.
All right, absolutely. Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and sign up for the Apple Podcast link. And if you like to talk to me, sign up for a strategy call. Hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.